Hey everyone, welcome back to the channel. Today, we're tackling a massive question that's on every investor's, homeowner's, and saver's mind. What will interest rates look like in 2026? Are we stuck in this higher for longer world, or is there some relief on the horizon? Stick around because we're going to break it all down, look at what the experts are saying, and explore what it could mean for your money. First, let's get a quick lay of the land. Over the past couple of years, central banks around the globe, like the Federal Reserve in the US, hiked interest rates at a historic pace. Why? To fight off that crazy inflation that made everything from groceries to gas so expensive. The idea was simple. Make borrowing money more expensive, cool down spending, and bring prices back under control. And to a large extent, it has worked. Inflation has come down significantly from its peak. But that success has come at a cost. Higher mortgage rates have put a freeze on the housing market for many. Businesses are thinking twice about expanding because loans are pricier. And for anyone with credit card debt or a variable rate loan, those monthly payments have really started to bite. So the big debate now is, what's the next move? Do central banks keep rates high to make absolutely sure inflation is dead and buried? Or do they start cutting to give the economy some breathing room? This is where the higher for longer narrative comes in. This theory suggests that we're not going back to the near-zero interest rates we saw for over a decade after the 2008 financial crisis. The new normal might be a world where interest rates are structurally higher. There are a few key arguments for this. First, for decades, companies moved production to cheaper countries, which kept the price of goods low. Now, with geopolitical tensions and a focus on supply chain security, many companies are bringing manufacturing back home or closer to home. This process, known as reshoring or friendshoring, is more expensive and could lead to persistent underlying inflation. Second, the green energy transition. Shifting our entire global economy from fossil fuels to renewables is a monumental task. It requires massive investment in new infrastructure, new technologies, and new materials like copper and lithium. This huge demand for resources and labor is, by its very nature, inflationary. It costs a lot of money to build the future, and that could keep upward pressure on prices. And third, demographics and labor markets. Many developed economies are facing aging populations and shrinking workforces. When there are fewer workers available, they can demand higher wages. While great for workers, this can lead to what's called a wage price spiral, where higher wages lead to higher prices, which in turn leads to demands for even higher wages. Central banks watch this very closely. So, if these forces are as powerful as some economists believe, central banks might have to keep interest rates elevated, say in the 3 to 4% range, just to keep inflation at their target of around 2%. This would be a huge shift from the world we got used to. But wait, not everyone is convinced. There's a strong counter-argument that says rates will eventually come back down, maybe not to zero, but certainly lower than they are today. Let's call this the back-to-normal camp. Their main point is technology, specifically artificial intelligence. The argument is that AI and automation are about to unlock massive productivity gains. Think about it. AI can write code, design products, manage logistics, and handle customer service more efficiently than ever before. This is a powerful deflationary force. When businesses become more productive, they can produce more goods and services at a lower cost, which puts downward pressure on prices. If AI delivers on even half of its promise, it could be the single biggest factor pushing inflation and therefore interest rates down over the long term. Another point for this camp is debt. Global debt levels, both public and private, are at record highs. Governments, corporations, and individuals are all loaded up. High interest rates make servicing this debt incredibly expensive. If rates stay high for too long, it could trigger a wave of defaults, bankruptcies, and a serious economic downturn. Central banks are acutely aware of this risk. They don't want to be the ones who crash the economy, so there will be immense pressure on them to cut rates as soon as inflation is truly under control. Finally, some economists believe the recent inflation spike was a one-off event. A perfect storm caused by the pandemic, supply chain chaos, and massive government stimulus. They argue that as these factors fade, things will naturally revert to the low inflation, low growth environment we had before 2020. In this scenario, central banks would have no reason to keep rates high and would eventually guide them back down to a more neutral level. So, you've got these two powerful, competing visions for the future. The higher for longer camp points to structural changes in the global economy, while the back to normal camp puts its faith in technology and the immense weight of global debt. Who's right? The honest answer is nobody knows for sure. Forecasting the economy 2 or 3 years out is notoriously difficult. But we can look at what the markets are pricing in. Right now, futures markets, where traders bet on the future path of interest rates, are suggesting a gradual decline. They are not pricing in a return to zero, but they also aren't fully buying into the higher for longer scenario at its most extreme. The market consensus seems to be a middle ground. Rates will come down from their current peaks, but will settle at a level higher than what we were used to pre-pandemic. So, what does this all mean for you and your financial plan leading up to 2026? Let's break it down into a few key areas. First, mortgages and housing. If you're a prospective home buyer, a world of moderately higher rates means affordability will continue to be a challenge. It might be wise to focus on improving your credit score and saving for a larger down payment to offset the higher borrowing costs. If you're an existing homeowner with a variable rate mortgage, you should be stress testing your budget for a higher for longer scenario. If you have the opportunity to lock in a fixed rate that you can afford, it might provide valuable peace of mind. Second, investing. The investment landscape changes dramatically with interest rates. For years, with cash earning zero, investors were pushed into riskier assets like stocks to get any kind of return. This was the Tina principle. There is no alternative. But now there are alternatives. Government bonds and high-yield savings accounts are offering attractive returns with much lower risk. For your portfolio heading into 2026, diversification will be more important than ever. A balanced portfolio that includes not just stocks, but also bonds and cash equivalents could be well positioned to handle whatever the future holds. Growth stocks, particularly in the tech sector, might face headwinds if rates stay high, while value-oriented companies that pay dividends could become more attractive. Third, savings and debt. This one's a double-edged sword. For savers, a higher rate environment is fantastic. Your money in a savings account or a certificate of deposit finally works for you again. Take advantage of it. Shop around for the best rates. For anyone with debt, especially high-interest credit card debt, the message is clear. Pay it down as aggressively as you can. In a higher-for-longer world, that debt becomes a much heavier anchor on your financial freedom. So, as we look towards 2026, we're standing at a crossroads. The global economy is being pulled in two different directions. On one side, you have the inflationary forces of deglobalization and the green transition. On the other, the deflationary power of technology and the crushing weight of global debt. My personal take, I lean towards the middle ground scenario. I don't think we're going back to 0% interest rates anytime soon. The structural shifts are real. But I also believe the deflationary power of AI is being underestimated, and the political pressure to avoid a debt-fueled crisis will prevent central banks from keeping rates punishingly high forever. But I expect LLC rates gradually decline from their current peaks, but settle in a 2.5 to 3.5% range in the long run. This would be a new regime, one that requires a different playbook for homeowners, investors, and savers. The key takeaway for all of us is to remain flexible and prepared for a range of outcomes. Don't bet your entire financial future on one single forecast. Build a robust financial plan that can withstand both higher rates and lower rates. That means managing your debt, building up your savings, and maintaining a diversified investment portfolio. The world of 2026 might look different from the past decade. But by understanding the forces at play, you can position yourself to navigate it successfully. What do you think? Are you in the higher for longer camp, or do you think rates will come crashing back down? Let me know your thoughts in the comments below. I read every single one. And if you found this breakdown helpful, do me a huge favor and hit that like button and subscribe for more deep dives into the economic trends that shape our world. Thanks for watching, and I'll see you in the next video.